You're listening to Across the Pond, a show about improving the lives of British expats living in America. Brought to you by Plan First Wealth.
How are you?
I am all right. This is our first full episode, isn't it? So I'm quite eager to start.
Let's dive straight in. So tell everyone who you are.
So I'm Thomas Quinn. I am President and CRO of Plan First Wealth.
Excellent.
Yourself?
I am Richard Taylor, and I am founder and CEO of Plan First Wealth.
Excellent. So what are we? Who's this podcast for? Let's start there.
Right. Well, so this is, as you said, this is our inaugural episode. This is a podcast for British expatriates living in America. Successful British expatriates living in America, which is the cohort that we serve. And to kick this off, we have picked 12 topics, 12 of the most pertinent topics that we think are relevant, apply to British expatriates living in America, and we're going to go through them one by one. Podcast might evolve into more than that over time, but to begin with, we're just going to cover topic by topic, starting today with UK pensions for US residents.
Yes. Should we start with the types? Should we start with defined contribution? Is that the easier of the two main types, would you say?
Okay. So, right. So this is let's start by defining what do we mean by UK pensions, because there are different sorts of UK pensions. So there are broadly two sorts. There are defined contribution and defined benefit. Defined contribution, also known as money purchase. Defined benefit, also known as final salary. So defined contribution money purchase is probably the most common, certainly nowadays is the most common, and it's literally just a pot of money. Like a 401k or IRA, it's a pot of money, and there are two sorts really. There are company pension schemes. You know, you're working for an employer, you contribute to it, your employer contributes to it. It's with an insurance company like Aviva, Scottish Widows, who I used to work for, et cetera, et cetera. Or it's a private pension. You know, you contributed to it outside of your employment, and or you transferred your company pension into a private pension once you left. Ostensibly, the same thing, can have different reporting requirements in the US, and I guess we'll touch on that later. But from a UK perspective, pretty much a similar thing. You know, a pot of money that you contributed to it, maybe your employer contributed to it. It's invested in a fund or funds. It goes up and down with the markets, and it's yours on your personal balance sheet, if you like.
Yeah, it might have some other nuance, mightn't it? In terms of some have like guaranteed annuity rates. When they get to retirement, they may be entitled to receive a guaranteed like X percent, maybe 5-6% a year when they retire. Some have with profits investments in there as well, which were designed in the 80s and 90s, investment products that were aimed to smooth out the return over the long term, and what that has ultimately meant is lower return. So we see quite a few of those, don't we? Any other sort of nuance or any other things that we generally see?
Older style ones might have protected PCLS, protected tax-free cash. That can be a benefit worth holding on to. That'd be a reason not to do anything with it, which I guess we'll talk about
I've seen a few with guaranteed growth rates as well, actually. Guaranteed growth rates of between 4 to 6%, guaranteed every year until they get to retirement. So there is some nuance in there, but generally speaking, they're pots of money which are invested in one way, shape, or another.
Yeah. And then there's defined benefit or final salary, which is always a company pension and is linked to the salary and the number of years service that someone has at a company when they retire. 60, 65 usually, that will start to kick in. They can get a lump sum and then an ongoing income that is guaranteed by the company pension scheme, rises with inflation to certain limits. Can be incredibly valuable and useful. So these are the two sorts of British pensions, and we lots of people move to America with these pensions.
Mm-hmm.
And then what we find is that people then just kind of let them languish. They don't know what they're in America. They can't move them to America. Being outside the UK makes everything more difficult. Being in America makes everything practically impossible. Anyway, any US citizens try to open a bank account or do something with money understands what I mean by that, and they just give up, understandably. And they put these in a drawer, literally or metaphorically, and every year plan on getting around to doing something, and 20 years pass, and they don't know what their options are, and they speak to us, and we kind of go, oh well, great, you do have options. It's a shame that you've waited 20 years, but no time like the present.
Yeah, the usual story of someone that's come over that wasn't expecting to stay here for long.
2 years.
Green card.
It's always 2 years.
Yeah, always 2 years. And then maybe they brought their wife, and they have kids, and then they've got grandkids, and then they decide to look at their pensions. That seems to be the general time when we hear from people.
Yeah.
You mentioned about can't transfer it to the US. Why can't you transfer it to the US? Because I think we get that question quite a lot. Some people say, oh, why can't I just roll this into my IRA?
The US doesn't allow it, I don't think. The US only allows rollovers into, I think, as I understand it, not a tax advisor, usual caveat. It's got to be a qualifying plan, and by its definition, a non-US plan can't be a qualifying plan. Therefore, you can't roll it into an IRA, or certainly not tax deferred. So it doesn't. It's just not really an option. So there's an opportunity cost associated with just leaving these languishing, not necessarily with a final salary pension per se, but certainly with a defined contribution. There's also then we repeatedly come across people who are reporting them incorrectly, either not at all, or inadequately or insufficiently. This is a perennial problem. The reporting requirements for a US persons are insanely complex and idiosyncratic, and many people still aren't aware that you have to report assets, even if you're not paying tax on them. You have to report them in multiple places on multiple forms, and the penalties are not doing so are draconian.
How I say it to clients is if you've got anything overseas, the IRS just want to know about it. They don't necessarily want to tax you on it, but they just want to know what you've got everywhere. And that isn't the case in the UK, is it? If you've got a property in wherever in Australia or something, you don't tell them every year what it's worth, and you don't tell them about your maybe Australian bank accounts that you maybe used to have. The US is different.
It is, yeah. It's different not just in the requirement, it's different in the repercussions, potential repercussions. So yeah, that's a big one for me, is when people come to us and we open up the bonnet and it just exposes a myriad of issues, which might put people off doing anything with it, but it's better that if those issues are lurking there, it's better that you identify them and take steps to resolve them, rather than the IRS finding out and reaching out to you about it. That's when it gets particularly unpleasant.
Yeah, I think if you've identified a problem and that might give you anxiety that you haven't necessarily reported something overseas, that's okay, as long as the IRS haven't told you. As long as maybe we've told you and you might have heard it on this podcast, and the IRS aren't making you aware that you haven't told them about these accounts overseas, and generally you can go back and try and fix that problem. Again, someone for questions for tax people, cross-border tax people.
Yep. Okay, so we've introduced the two sorts of UK pensions, and we talked about the problem that we see, which is that people move here and then just kind of put them to one side and leave them for 20 years or however long. Obviously, we think there's a better way, or what are the options then for UK expats with British pensions now living in America?
What we generally do is we'll review each pension, and maybe the advice is to firstly keep it. Maybe that's something that we do recommend for either.
Well, to your point before, the older style pensions, there could be the guaranteed annuity rates. There could be the protected tax-free cash (PCLS). There could be reasons to leave them because those sort of benefits are lost upon transfer. So, there may be legitimate reasons to not do anything with them.
With defined contribution, we don't say that too often. I would say more often we see an opportunity cost, but that's option one, I guess, leaving the scheme or schemes where they are. Option two is you could consolidate within the current schemes. Let's say you've got a few defined contributions pensions, and you could consolidate within those schemes. Option three is the more common one, and if you did a research online, you'll probably come across the term SIP, which stands for a self-invested personal pension, which is very similar to an IRA. And this is a pension vehicle where you could consolidate any number of pensions, defined contribution or defined benefit, but maybe we just spend a bit of time
or both.
Or maybe we spend a bit of time about the defined benefit transfer process because that is complex. But you can consolidate within the SIP, and then you've got a bit more autonomy on how to invest that. You can invest it in some more modern type investment vehicles. You can put it to your time horizon and risk appetite, and
you can just have more control over it. You and or your advisors. It's just a modern vehicle with the bells and whistles and options and functionality of a modern vehicle versus what I call the defined contribution company or personal pensions, which are accumulation pots. It's, does what they say on the tin. They
cookie
have a
cutter.
handful of funds, simple, blunt instrument, and often quite effective for what they need to do. But once you start talking about significant sums of money, and also in line with our name, Plan First, managing assets, a global balance sheet in line with your personal financial plan, I would argue that you need something a bit more sophisticated, something with the options. And it's not just the investment options. For people living in America and likely to retire in America, you want currency options. You want without going down a rabbit hole of what the exchange rate is currently doing, the standing position really is you want your pensions, your assets, to the extent that you can, in the currency that you're going to retire and live in. So you want them in dollars. So you want a SIP that has the functionality to not only invest in dollar investments, funds, ETFs, but also the functionality to hold US dollar cash and withdraw in dollars, which not all do. In fact, not many do, and within that, even fewer will manage or take on US residents. So, because I alluded to before, everything's a little bit harder when you're an expat. Everything's a lot harder when you're an expat in America.
It is, yeah, and those options are available to people as well. Like you can have a UK pension invested and paid out in dollars, and that might seem quite strange to some people. But it's available. It's there.
Yeah, it's not. The key distinction I think here to make is it's not in America. It's the closest thing you're going to get to getting your pensions in America. They're not in America. They're very much still in the UK. A SIP is a UK vehicle. It's still under HMRC, but the closest you're going to get it into dollars. I assume you are into dollars, invested in dollars, withdrawing dollars. And this is probably a topic for another podcast, but you can also apply for an NT tax code, assuming you're a US resident full-time, and have it paid out gross.
Gross of UK tax.
Gross of UK tax, yeah. You then declare on your US return and pay tax just in the US as a US resident. I think that's the closest you're going to get to getting it into the US.
Yeah.
It's not in the US. It's the closest you're going to get.
And so I think that sometimes causes people a bit of gripe still that it's not in the US, but for all intents and purposes, it would look, and we would we structure them very similar to how we do an IRA, don't we? Really?
Yeah. Well, we apply the same investment philosophy. We just use different instruments, and we incorporate it into a client's financial plan, whether they're in accumulation or, even more importantly, the decumulation phase.
Those, because that is a whole other beast of trying to sort of transfer one of those, because it's all well and like a SIP is an option, and defined contribution transfers to a SIP are relatively straightforward, but a defined benefit pension transfer to a SIP is complex.
I completely agree. Let's just wrap that up then. So, a SIP is an option for defined benefit or defined contribution. We've primarily been talking, I guess, we've been thinking about defined contribution because it's just you're taking a pot of money, and provided there's no bells and whistles that you don't want to lose, you're transferring usually several pots of money into a single pot of money over here, which is a SIP, and this SIP is usually more sophisticated, more options, more relevant for you, all the stuff we've already talked about, right? It's a relatively simple and straightforward decision-making process. Defined benefit, to your point, is a different ballgame altogether. Here you're potentially swapping or looking into swapping a guaranteed income, which is someone else's problem. That's how I always explain it. This is right now, you just sit back and cash the checks. It's great. It's someone else's problem. You're investigating swapping that for a pot of money that goes on your balance sheet, becomes yours almost. It's still in a trust. Don't get wrapped up in that. Legally, it's not yours, but it's on your balance sheet. You have control over it to a certain extent. But it's your problem, and a lot of people want that problem, but not everyone. And you have to, when you're investigating swapping this income stream for a pot of money, you have to start from a position of it's not in your best interests. A guaranteed inflation-linked pot of money is enormously beneficial is the wrong word, but valuable. But it's enormously valuable and should not be given up lightly. But there are certain circumstances where it does make sense, or people want that.
Mm-hmm. Yeah, the regulator comes from the position that it's within your interest to keep this pension, and if you were to transfer it, then someone helping you do the transfer would have to prove that it's within your interest to transfer the pension, that the SIP is a better option for you. And that's a bit costly. You have to find a pension transfer specialist. You might see that on your documents if you request a statement. There's a path forward, though. There are pension transfer specialists out there that can help you review and analyze and work out if it's the right thing for you to do.
I think people enormously underestimate the difficulty and the complexity. How many times do we have people reach out to us? I've got this transfer value, I want to move it. You're like, well, there's a bit more to it than that. And you start laying out right, so we need the process, the timeline, the cost, not just our cost, the total cost. And people are just horrified. And I kind of get it, but also that is there to protect them ultimately.
The process is,
the process is, and but just the sheer amount of work and the cost involved in the process means that already coming from a place of this is not right for most people, extends that even further. It has to be an extremely compelling valuation on top of an extremely compelling personal situation to warrant it, and the simple fact is the vast majority don't meet that criteria. I would say more in the US do, because you think about who comes to the US, it's successful people transferring within their company, right? So this is tends to be quite senior people who have got other assets, who are generally quite well off, who are generally reasonably financially sophisticated. So I think that means that the people we come across are more likely to tick those boxes, but still, definitely the minority, perhaps. But it's anyway to your point. There are options. It's usually worth investigating. It's not a done deal. Don't think because you have a transfer value, this is just something that you can do easily. It much more is the case with a defined contribution / money purchase scheme, although that still has its challenges. What was it recently? You look back over your emails to trying to transfer out a couple of defined contributions. Was it like 300 or 400 emails back and forth?
Yeah, 300 emails where that person's surname was referenced in my inbox, because we had exchanged 300 emails with trustees and internal admin updates. It's still
it's an operation.
It still takes a few months, yeah.
And you know what? It's extremely frustrating and difficult. But there are pension scams out there. There really are people scamming people out their pensions. So I understand where it's coming from, as frustrating as it is, but there's a lot of work, and the onus is on us and the clients to prove that it's not a scam.
Yeah, and it is all within the best interests of you, the listener, the client, that person with a UK pension. So you try and see it as a positive thing when going through this process, but it just, if you're going to embark on it, then just set aside a few months of time, and you'll get there in the end.
Yeah. So someone has a well, what you know what we haven't actually mentioned is what happens when you have a SIP, or even if you don't have a SIP, you leave it in the UK. And you take an annuity, which I've not seen many UK annuities in the last few years with interest rates low. If interest rates are going up, maybe that'll change, but I don't know, because a UK pension buying a UK annuity will be in pounds as well, and then is that appropriate for a US resident? But it's an option. Annuities
so this is when you get
an
to
option.
retirement.
The other option then is
how
drawdown,
can you start using
which
your
is where you
pension
when you start, and you start pulling money out of your pension. And in theory, you can take it all out. And in the UK, you are putting the lifetime allowance to one side for a second, which I guess we'll come back to in a second. You are entitled to 25% tax-free, PCLS, pension commencement lump sum, and the rest is taxable as income. So in the US, again, tax advisor territory, but in the US, you can take a 25% lump sum. Whether it's taxable or not is a question mark. There are tax advisors who say under the taxation treaty it isn't. There are some who say it is. That's between you and your tax advisor to determine what to do. And then the states might have a different position as well. Some states it's not taxable. Some states, or it depends what you do federally, and some it absolutely is. There's no avoiding it. But again, that's between you and your tax advisor, and that's why it's another reason why I think it's so important to have a cross-border tax advisor, and not just any cross-border tax advisor, a cross-border who has specific experience and understanding of.
It might be a little bit more expensive,
the
but
other
it
country
save you
where your assets
a lot
are.
of money. If one says it's taxable and one says it's not, then there's a big difference there.
Yeah. And you've got the different reporting requirements with your whether you've got a DB or a DC, whether the DC is a personal pension or a company pension scheme, whether it's a SIP. There's always going to be some sort of reporting required, and then the different forms depending on what pension it is, and you need a cross-border advisor for that, in my opinion, always. Anyway, back to my point about drawdown. So you can take drawdown 25%. You're entitled to a lump sum, whether it's taxable or not is a question mark, and but the remaining 75% is always going to be taxable federally and at state level. And if you're a US resident, the US gets first taxing rights, as I understand it. You can have tax withheld at source in the UK though, and then that can get messy, offsetting or trying to claim it back, which is why you probably want to do with the NT tax code. We'll talk about that in another episode though. And yeah, when you there's a lifetime allowance.
I mean,
which we're not going to get into
summary
here.
Points on that. I mean,
too much.
It's a savings. Yeah.
It's a stealth tax in the UK to tax the rich. If you consider more than £1 million in a pension, you're rich. Apparently, I'm not sure.
And essentially, it's just over $1 million. It goes up by inflation.
They're going to tax you at source.
Stop that for the next 5 years. So it's just over $1 million. Once you save over $1 million into a UK pension, and they'll add up all of your UK pensions, then essentially there's a tax of 25% or 55%, depending on how you take those distributions. Yeah, so then you've got income tax on top of that 25%.
Yeah.
So you're taxed twice on that. So we'll probably save that for another podcast where we go into a little bit more detail. But that's just something to be wary of, is that. But don't get too worried about it.
Yeah. Yeah. Work with cross-border experts, and particularly a tax advisor, and they'll help you manage that in the best way, rather than it coming as a nasty surprise later on. Anyway, right. So, have we missed anything? Is there anything we need to? I'm sure we have. I'm sure we've missed loads.
If we have, by all means, do reach out to us. We are always available, and there is a wealth of knowledge on our website as well. If you want to do some extra reading on things that we've discussed today, like an NT tax code, we've mentioned that a couple of times. Like have a quick Google. There's information out there, and especially on our website.
You go to our website. We've got blogs. We've got videos. As I say, this is the first of a series of 12 of the most pertinent topics, and we're going to cover a lot of the things we've touched on today, I think, in more detail. Head to our website, see if you can reach out to us. You can book in with us if you feel so inclined, and we'll do what we can to help. So, next topic for us, we plan on talking about US retirement accounts from an expat
we'll be recording
perspective.
That one next, won't we? And we'll try and keep this short, because sometimes these topics can get a little bit dry. So we'll try and keep these short. We'll try and keep them super informative and helpful. And tune in to us when you next see this, and subscribe to our podcast, so that you'll get notified when we do the US Retirement Account podcast. Thanks for listening to this episode of Across the Pond. This podcast is brought to you by Plan First Wealth. For more information about Plan First Wealth and Across the Pond, visit us at planfirstwealth.com. If you like this episode, consider sharing it with fellow Brits across the US. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you listen to your podcasts. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.